in particular, looking at the consumption measures, I think are very interesting along this dynamic. First quarter GDP showed a moderation of end consumer spending contribution to GDP growth, moving down to about 1% in terms of contribution. That's about half of what it was in the second half of last year. And then you're also seeing in more timely measures, for instance, in the personal consumption expenditures, you're seeing those measures pretty flat for the second quarter. Those measures just growth on their own about 0.8% annualized for the first 2 months of the second quarter that have been reported. We'll find out the rest at the end of this month when the full GDP report comes out. But odds are we'll see personal consumption be, pretty modest over the course of the second quarter. And again, part of that general gradual deceleration that we're seeing in the economy. At the same time, on the flip side, we've talked a lot about, if you've been around here long enough, you've heard me talk about the income-driven expansion. And so the labor markets are very important very important linchpin in terms of continuing to drive the macroeconomy forward and to continue to get, reasonably good spending and growth. And what we've seen there is not a significant weakening of the labor market, but we have seen some moderation across a number of different measures in the labor market. Here showing the timeliest measures seen with the claims data. The initial claims data, which is a good indication of the rate of firings, is still pretty stable relative to where we've been. The thing that we're starting to see is that continuing claims data. It's starting to creep up. It's low in any absolute sense, but it's starting to creep up, reflecting the fact that some folks are feeling a little bit more challenge in moving from unemployment back to employment. So the lengthening of the duration of employment. Now, these are the sorts of things that, this is not a fast-paced recessionary curve. In order to see that, you'd have to probably see a much steeper curve over there on initial claims with firings, but it is indicative of some softening of the overall labor market. And I think, the basic dynamic, if you look under the hood, looking at the JOLTS data, is it's not a slowdown. It's not a significant slowdown driven labor weakening. What we're seeing more is essentially just a hesitancy to hire. So what we're seeing, quits, soft relative to history, about at the pre-COVID rate. And we're seeing firings, that's layoffs and discharges. Those are at the pre-COVID rate or maybe just a touch below. Both of those would indicate that, there's not a lot of, labor's not really moving around very much. Companies are fine with the labor that they have. The main area that's the outlier is that the hiring rate has moderated to some extent. And so that's what you're seeing here. On the left-hand side are the quits and layoffs and discharges, and there on the right-hand side is the hiring rate, which is, low relative to the pre-COVID pace noted in the line there. And as a result of the slowing of growth, the slowing of employment growth, we're basically seeing a slowing of nominal demand. And so we've talked at length about how this is an income-driven expansion. That income is being driven by continued employment growth as well as wage growth. But those elements are softening, like we talked about last month. And so we're seeing this sort of gradual softening of nominal incomes down to about 5%, give or take, on an annualized growth basis. And that's corresponding with a softening of overall nominal consumption, which is also growing about 5% at this point. So that puts us in an overall dynamic: nominal growth about 5%, nominal spending about 5%. That's not a terrible environment for economic conditions ahead. It's just certainly not consistent with a significant growth acceleration that's being expected, for instance, in analyst expectations. And that's really the outlier here. And it's challenging in these sorts of environments because when it's clear that there's a direction that the economy is going in terms of moving to a quick recession or moving to a boom, and a lot of times you can follow the momentum And you don't have to get too worried about exactly what's priced in, because the momentum by itself is sufficient to tell you, which direction to go. In these late cycle environments, it's a bit different. Most of us haven't seen these late cycle environments, but if you go back and study the ones in the 50s and the 60s, and you study them across countries, it's very normal that you get in a late cycle environment growth that continues the growth that continues, but starts to moderate as the central bank tightens in response to elevated inflation pressures. But expectations, which are almost always based on backward-looking experience, continue to expect relatively strong growth just as the economy is slowing. And so what we see here amongst analyst expectations in the equity market is very consistent with that sort of very classic late cycle dynamic. If we look at the equity market, we look at, in this case, S&P 500 EPS, over the course of the last 8 quarters, it's basically been flat. There's been a lot of movement under the hood in terms of who is gaining and who isn't. But the big picture is 8 quarters, flat earnings. But when we look at how analysts are expecting to see earnings grow over the course of the next 12 to 24 months, they're expecting a boom in earnings growth. 17% year-over-year earnings growth expected by the end of the fourth quarter, and a combination of near 30% earnings growth over the course of by the end of calendar year 2025 in comparison to calendar year 2023. Those are huge numbers, huge earnings growth that are expected, particularly in light of the fact that we've had basically flat earnings growth over the course of the last couple of years. Just to draw some perspective on that, if we look at how earnings growth has played out over the course of the last couple of cycles, it's not unheard of to have earnings growth in sort of the mid double-digit range, even for a couple of years. The thing that's unusual about it is that it would happen at the late cycle rather than coming out of a bottom. So we have seen earnings growth consistent with what's expected. For instance, coming out of COVID, coming out of the financial crisis, and after a lot of effort coming out of the tech bust. But in no cases have we seen earnings growth persist at that level for multiple years in a late cycle environment. And so what is being expected is basically very strong earnings growth at a time when the economy is slowing in response to the tightening.